Good afternoon. My name is Song Ho-jo from Austrade. I'm the moderator today. First of all, thank you so much for joining the infrastructure webinar today. Today's webinar agenda is that the Austrade Senior Trade and Investment Commissioner Julie King will deliver welcome remark, and then Kofi Mr. Shim is also deliver welcome remark. Then three speakers from Frontier Advisors, Starford Capital, and 퀸즈랜드 Investment Corporation will present global infrastructure trend, infrastructure secondary, and the investment theme. So I'd like to introduce Julie King. Julie started the role as the Senior Trade and Investment Commissioner for Korea and Mongolia in January this year. Her role is focused on attracting Korean investors to Australia and growing Australia's goods and services trade to Korea and Mongolia. Since her commencement with Austrade in 2020, Julie previously had worked as the head of the Austrade Centre of Excellence in Health in Melbourne, Australia. Julie has the almost 30 years of the health and the biotech experience before joining Austrade. Julie has the completed Bachelor of the Applied Science from RMIT, graduate diploma in business from Monash University, and the Master of Engineering from RMIT. Over to you, Julie.
Thank you very much, Sung-ho, and I would like to give a warm welcome to all of our guests from the Korean financial sector and thank them very much for attending this webinar, in addition to welcoming our three Australian speakers. In the room with us today, in addition to Mr. Cho, we have Trade Commissioner Mr. Ron Green and Senior Business Development Manager Kai Arndt. So this is the team here at the seminar today. So Mr. Cho has given a very nice introduction to myself. For those of you who aren't aware, the Australian Trade and Investment Commission, otherwise known as Austrade, is Australia's trade and investment promotion agency. We have more than 70 offices globally, including a significant presence in Australia, and our purpose is to help grow Australia's economic prosperity through trade and investment. As Mr. Cho said, I started my duties here in Seoul in January, and I'm very fortunate that we have a very strong team here of locally engaged staff, as well as my two other Australian colleagues and our embassy colleagues who support us as well. COFIA, we know, is a very, very important stakeholder for Austrade and has a very long history of supporting Austrade events for the financial sector here in Seoul. So I would like to, on behalf of my colleagues, thank COFIA very much for supporting, co-hosting this webinar, as well as other programs they have supported. So while many of you may think of Australia as, first of all, a great holiday destination, and it is, and I'll encourage you to travel once borders open, and a great place for great food and resources, in fact, in reality, it's one of the most dynamic and sophisticated economies in the world, driven by services and technology. For example, mining contributes over 7% to our GDP, and finance and insurance services make up over 9% of the Australian economy. Financial services trade between Australia and Korea represents significant potential for future growth and will provide the foundation for a more diverse bilateral trade relationship. Under the free trade agreement between Korea and Australia that's been in place for about 5 years, Australian financial service providers have been awarded with the best treatment Korea has agreed with any trading partner, on par with its agreements with the United States and Europe. And I should add too that this year is the 60th anniversary of diplomatic relations between Korea and Australia. So it just shows Australia and Korea are trusted partners and have been so for a number of years. We are privileged today to hear from three speakers who will set the scene for infrastructure opportunities between Korea and Australia. Mr. Cho will introduce the speakers, but the companies they represent are Starford Capital Partners, which manages the Starford International Timberland 9 Fund, You may be aware this flagship fund has just been announced as manager of a US $150 million fund for global timberland investment by the Korea National Pension Service. We are also joined by the Queensland Investment Corporation, QIC, that you see on your screen, which has been selected as one of the best asset managers by Korea Economic Daily, as well as Korea's largest institutional investors. And our third company represented today is Frontier Advisors, which is one of the top institutional investment advisory consultancies in Australia and has been at the forefront of delivering investment advice and technology to institutional investors for more than 25 years. I trust that by the end of today's webinar, you will have a greater understanding of what Australian fund managers have to offer and how such funds could be incorporated into your investment strategy. I hope you enjoy the session. Thank you.
Thank you, Julie. Now, I want to invite Mr. Shim of Kofia for a welcome remark. Mr. Shim?
네, 안녕하세요. Hi, good afternoon, everyone. I'm Deputy Director of International Affairs Department at Korea Financial Investment Association, KOFIA. Thank you for joining us at the virtual event on global infrastructure investment market. And I would like to show my deepest appreciation to the Austrade team for co-hosting this event. And I believe it's also meaningful for both organizations because it is the first collaborative event since Ms. Julie Ken, the newly representing Austrade Korea as a trade commissioner. Last April, when we had the first infrastructure webinar with Austrade, we only had 40 registrations from the financial industry. But today, we have more than 110 registrations from 50 different institutions. So I think this figure clearly shows a trend among Korean investors to expand their investment in infrastructure. I also believe that's a significant increase in the number of participants reflect their big interest in the information and analysis on the infrastructure investment market that the Australian speakers will deliver today. And one of the reasons why we are considering this event as such a valuable opportunity for all Korean audience. So lastly, on behalf of Korean attendees today, I would like to extend heartfelt appreciation to all the Australian speakers. Thank you so much. That's it. Mr. Cho, over to you.
Thank you, Mr. Shin. Kofia is a very long relationship, the alive for Austrade. And we have done many events with Kofia in the past. I'd like to introduce the Manishi Laskoti from Frontier. Manishi Laskoti is a principal consultant and infrastructure specialist with the Frontier having joined in firm in August 2017. He previously provided infrastructure consulting and investment support to Frontier client and also undertake manager research. Prior to joining Frontier, Manish worked for IFA Investor as a vice president in the infrastructure team and undertaking direct investment and asset management with a specialization in airport. Manish holds an MBA qualification from London Business School, majoring in finance and Bachelor of the Engineering with honors from the University of Melbourne. So, okay, over to the Manish.
Mr. Cho, and a warm welcome to all the guests here today. It's a wonderful opportunity to speak to you about infrastructure. It's a topic I love very much. Will you be showing the slides on the screen there? Excellent, thank you. So what I thought I'd speak to you about today is mid-market infrastructure, and particularly in Europe. Now, typically, as part of the real assets team in Frontier, we would actually go out annually to Europe or to the US and undertake a pretty long and arduous research trip, and we'd meet with a number of managers and a number of stakeholders involved in infrastructure and try and get their views on where the industry is at, where are the opportunities, and the sentiment towards the asset class. Now, as we all know, 2020 was a very different year, so we've really had to adapt to a new normal. And a bunch of us actually sat around in our studies and homes, and actually with a whole bunch of European managers late last year to talk about mid-market European infrastructure, and we did it as a virtual trip in European hours. And I guess what we tried to uncover wasn't very different to what we would do on a physical trip. We actually tried to find out where's the fundraising sentiment, where's the investment sentiment, what really stood as being resilient for infrastructure, and what are some of the thematics in the future. And I'd like to cover some of the latter elements of that in this presentation. So if we move to the next slide there, let me begin by actually just talking about the market. As you'll see here, Europe is actually the second largest market or region for investments. It's attracted a lot of investments over the last few years. It's only second to North America, and I guess well, at least we have to assume it's larger than China, because there's really very little private investments in China. And over the last few years, there's been a lot of greenfield capital that's gone into European infrastructure. And you can see on the bottom right there, a lot of that's actually going into renewables. Not surprisingly, Europe, as you'll all know, is actually very, very amenable to sustainable infrastructure and green infrastructure. So not surprisingly, a lot of capital going into solar, going into wind and offshore wind. But when you look on the chart on the left, there's still a bit of a dilemma here, because Europe requires a lot of investments. According to Global Infrastructure, Europe needs at least another 15 trillion of capital out until 2040. On current run rates, it will get to about 13 trillion. So there's a 2 trillion gap that private investments need to make up, or private capital needs to make up. And I think there's plenty of opportunities there for European investors, particularly when we talk about the mid-market. Now, the good thing about Europe is it has a whole ecosystem built around infrastructure. When you look at the demand side, they've got the right demographics, there's sufficient demand, there's uniform policy support across Europe through the EU. There's a large supply of financing banks and multilateral institutions, and there's no shortage of industrial know-how. So Europe is home to many large industrial conglomerates. So there's plenty of opportunities for development assets to come to hand. And I think that provides a lot of support for outside investors who are looking at Europe for continuous influx of capital, or to put money to work. So we move to the next slide there. So once you take the market into account, we have to look at what's actually happening in Europe. In the middle of the pandemic last year, well, maybe at the start of the pandemic, I guess, by June 2020, Europe actually, or the EU, the European Union, launched a very, what we'd call a very interesting plan or initiative, and it was a very bold plan. It's called the European Green Deal. Many of you have already heard about it and read about it. It's Europe's $1 trillion plan to reinvigorate Europe's economy. It was really developed to support a recovery, given that they were facing prospects of recession. But they wanted the $1 trillion invest in a very responsible way. And a lot of that capital is going to go into sustainable investments, i.e. cheap, clean energy, creating a circular economy where there's no waste, and helping European nations make the transition, those who are not ready to accept what this Green Deal remit means. But behind all of that bold promise is also a very real, tangible effort to cut greenhouse gas emissions, 50 to 55% by 2030, and really they want to be net zero by 2050, which I think is an incredible feat. But when you think about it at another level, what this is really doing, Europe is in the process of creating a very interesting template for how investments should be done and how sustainable investments should be done for them to follow. And this will be basically what the rest of the world will end up copying, or be forced to mimic, because for investments to come into Europe, they will need to abide by the Green Deal legislation and rules and regulations that are put in place. So whilst there might be some hiccups, we think this is an exciting opportunity to put some sustainable and responsible investments into ground floor infrastructure. Let's move to the next slide there. And just to take that step further, I guess if we talk about the Green Deal, it's really about energy transition. So, you're going to get a lot of renewable energy that's going to be supported by the Green Deal. Decarbonisation of electricity grids, that means greater use of distributed generation, use of energy storage, large-scale batteries, intelligent generation, and the stabilisation infrastructure that's required to blend in a lot of renewables with baseload energy, which has been coming from nuclear and coal and gas to some extent. And that's going to create a lot of exciting opportunities to invest in Europe's electricity grids. There's also plans to invest in large-scale electrification for mobility. So EV charging infrastructure is going to be a very large thematic. As you can see on the chart on the top right, we're really at the genesis of all this, thematic. Germany, UK, France, they've got some concessions going to invest in EV charging infrastructure, but look at the task at hand. They've got to get to a number of charge points, and that's going to require substantial investment and substantial organisation to actually roll out EV charging right across the country. And these might be done in concessions, so there's a great opportunity there. Last but not least, Europe is also planning for a very green hydrogen economy. And hydrogen, while it might be in a bit of a trial phase at the moment, Europe's actually dedicated to it. They're going to throw close to $20 to $40 billion by 2030 at it to create a viable industry. And that will mean a cheap green fuel, whether that's powered by renewables for the electrolysis and transporting that and then converting their dirty industry to cleaner energy, using cleaner energy inputs, whether that's their public transport, that's industrial production, etc. So there's some exciting opportunities for hydrogen yet, but it's still early stage. So let's move to the next slide quickly. But I think a big element of the Green Deal is also digital infrastructure. I think you'll all be aware now that during the lockdown, a lot of our habits changed. Sitting in the comforts of our home, we're working from home, we're shopping online, effectively moving our lives online effectively. So that has great implications for data, and data is a new commodity. And that trend, as I can tell, is it's going to be irreversible. It's going to continue to grow, particularly as we get more interconnected devices and as 5G rolls out. So if you think about Western Europe and Central Europe are expected to grow at roughly 28 and 27% year on year. So that bandwidth growth is absolutely critical for supporting a lot of high bandwidth intensive applications, whether that's streaming or video conferencing. And if you think human communication is going to plateau out, well, there's going to be a lot of interconnected devices that will be able to take advantage of 5G, and there'll be a lot of machine-to-machine and machine-to-human communication as well. So this is a positive for data, and what that means is there'll be a number of subsets in telecoms that will actually benefit, and listed them there: cell towers, with 5G and higher frequencies and millimeter wave. You do need a lot of towers because the penetration reduces with high frequencies. A lot of towers, a lot of pico cells, and a lot of distributed antenna systems. Data centers, obviously, Europe's got very stringent laws around localization, privacy, and data safeguarding. So there's going to be a lot of data center demand, particularly in European hubs of Frankfurt, Amsterdam, Paris, as well as UK as well. And fiber. I think the story of 2020 when it comes to telecom has been really fiber, but that's not going to stop because Europe's throwing a lot of money towards getting minimum penetration and bandwidths right across Europe. Ubiquitous broadband is what they're after. And FTTN, FTTP, these networks are being rolled out second to none all over Europe. So that's a positive. And I think what you'll also see, the financial burden of building out 5G will mean that telecom operators or the MNOs are going to be more open to receiving external investments in their radio access networks. But as we caveat, if everything's popular, that means there's a lot of capital flowing in, and that means valuations are going up. So investors need to be very mindful of that. Move to the next slide. So I've listed here a few other interesting subsectors that will be of interest for mid-market infrastructure in Europe. Renewables I've already touched on, but you can see solar. It might be a bit small there, but you can see solar, offshore wind, onshore wind, whether it's in Southern Europe for solar, Scandinavia for wind and offshore wind. These technologies will continue to grow. There's now legislation and there's broad support. Battery storage, whilst they may not be completely viable today at about roughly $180 per kilowatt hour, but they will become much more economically viable as we move forward, whether they're for standalone projects or for ancillary capacity support in peak periods. So I think battery deployment is coming in a very large way in Europe. Smart metering, so I've put some numbers there. You would have already seen a few deals that some of the managers have done in Europe, but this is just a beginning of a trend. And I think where EU stands is 123 million households covered when they were targeting 200 million by 2020. They're a long way off. They're really targeting about 266 million electricity meters by 2030 and 50 million by 2024 for gas. So enormous potential for investments in metering rollouts in long-term concessions. And waste management is another exciting area. A lot of deals starting to happen now. Europe traditionally has been very compliant for renewables, recycling. They have a very good culture for that. I think opportunities in this segment will only grow. Last but not least, we've mentioned PFIs and PPPs, mixed experiences by a lot of the jurisdictions. The UK has had bad experiences with PFI, but PPPs have had a really good role to play, particularly when it comes to countries like Netherlands. You talk about schools in France, schools, hospitals, prisons, and also Southern Europe. Germany, not so much, but I think there are select opportunities for PPP. So that will certainly play a role for less risk-averse investors. We move to the next slide, please. I think an interesting evolution we've seen in the mid-market, talking to a lot of managers last year, is the vast change we've seen in the makeup of mid-market. I think if you look back as early as 15 years ago and even as late as 10 years ago, really mid-market infrastructure in Europe was started by a lot of Anglo-centric firms. And it was a lot of Australian companies who were really starting up infrastructure investments. Certainly Macquarie, IFM AMP Capital, First State Investments, and QIC. My colleague from QIC will speak on the topic later, but these firms were actually there at the genesis of a movement in investing in infrastructure and creating an asset class. But where are some of these firms today? I mean, they gained a lot of success deploying capital, raising more capital, getting bigger. So what I see them doing now is they're really looking for the big deals, the rare woolly mammoths in infrastructure. So they're getting in a different space, and they've created a vacuum, a perfect vacuum, which has been thankfully taken up by a lot of talented European managers, homegrown managers, investors who are potentially working for large European banks, investors or for funds like Macquarie and First State. They've gone away and started their own firms, and slowly they've actually gained traction and created very attractive local outfits who, one, are very well connected to the European mid-market segment. They have relationships. Relationships matter for a lot in Europe. They speak 3 to 4 languages, and they come out of European houses where they have the foundations and experiences in dealing with European legislation. So that's a positive. And quite a few of these young startup firms have a very industrial DNA. So they actually deal with the likes of the Siemens Gamesas and the energy utilities like Total, and can actually extract non-core infrastructure assets out of them. So they've gained a lot of success in that way. So I think this is an exciting element. So we see either investing with them or partnering with them for investments. And the last slide, if we move to that. Last but not least, I'd like to talk about ESG. ESG is something that tends to get overlooked, and it may appear last in my slide deck here, but it's not on purpose. It's a very important element. I think with the Green Deal will come a lot of focus on ESG and a lot of scrutiny on ESG. We've found that European investors and pension funds are very diligent and very stringent when it comes to assessing ESG, and they set a very high benchmark for ensuring that managers are compliant, meeting their duties and requirements to meet ESG obligations, whether that's for measuring effectiveness of the ESG initiatives or creating sustainable ESG initiatives for social and climate change. And I think that's just going to increase. So regulation will force managers and investors to be much more proactive and provide greater transparency when it comes to social, climate, and sustainability initiatives. And I would only suggest that if you're an investor looking to Europe, certainly pay a lot of attention to this, because EU will require very stringent focus on ESG going forward. I'll stop there and take any questions if there are any.
We are going to have the Q&A session at the end of the session. So thank you for your insight for the global mid-market opportunity, especially in European market. It's good to hear that there are many Australian fund managers. They are doing business in Europe, including IFM and Starford Capital and QIC and the Colonial First. So that's good, the sign for Australia. Now I'd like to invite next speaker from Starford Capital Partners, John Chaknik. He's the principal within infrastructure at Starford Capital Partners, and is primarily responsible for the portfolio management and the client relationship, as well as the supporting the investment team in sourcing and due diligence. Prior to joining Starford in 2012, John was with BDO and Grant Thornton in Australia, managing a broad range of the clients across the various industries. He has over 15 years of experience in providing taxation and audiovisual service to private and infrastructure clients. John is a member of the Australian Institute of Chartered Accountants and received a Bachelor of Commerce from University of Western Sydney. So over to the John.
Thank you, Mr. Cho. I would like to start by welcoming you all, and also giving special thanks to Austrade and Kofia for making today possible and allowing me the opportunity to speak with you about one of my favourite topics, infrastructure secondaries. I might just ask you if it's okay to flick to the next slide, please. So for those of you who are not familiar with Starford Capital Partners, we're an independent investment and advisory firm that focuses on real assets and private markets. Founded in 2000, we are 100% employee owned, and today we have over 80 professionals managing almost $8 billion US on behalf of institutional investors across the globe. On the real assets side of our business, we focus on infrastructure, timberland, and agriculture and food. Specifically within infrastructure, we have around 1.5 billion US under management, with a strategy that primarily focuses on core infrastructure secondaries and complementary co-investments. Next slide, please. Next slide. Oh, sorry, that's right. Today, I'm going to cover some of the trends that we are seeing in infrastructure secondaries market. But before I do that, let's take a moment to touch on what secondaries are and why they're becoming increasingly popular. Put simply, secondaries refer to the acquisition of LP interests in underlying funds via the secondaries market. If we think about the life cycle of a primary infrastructure fund, we would typically expect an investment period of, say, 3 to 5 years and a full term for the fund of anywhere between 10 and 15. The diagrams here illustrate this life cycle, and through the investment period, we typically see staggered capital calls, some J-curve effect, and little or no cash yield as the portfolio is ramping up. On average, our secondary investments occur between years 5 to 8, and as you will see on the right diagram, we would be coming into the fund after that J-curve has dissipated and the yield distributions have commenced. So why sell? Well, the short answer is a lot can change over time. By way of example, we can look at the Australian market. And as Mr. Rastogi just mentioned, Australia was a pioneer in the development of infrastructure asset class in the 1990s, with leading funds such as Macquarie Bank and IFM being fueled by capital from growing institutions locally, and namely Australian superannuation funds. More recently, however, with the consolidation of the superannuation industry and emergence of these mega funds, we've seen a shift of appetite away from the fund vehicles and more in favour of large direct or syndicated deals. Part of this transition has involved an increased reliance on secondary transactions to facilitate the shift, and in turn, Australian funds became a driving force behind the secondaries market for infrastructure. We're confident that this trend will continue in Australia, but it's also important to take a global approach to secondaries and consider the global drivers and similar trends that we see across other asset classes. Next slide, please. In respect to trends of other asset classes, this was particularly important in the early stages of the infrastructure secondaries market. And allow me to take a moment just to elaborate on this. 10 years ago, when we were preparing for the launch of our first infrastructure secondaries fund, the question we were asked time and time again was, how can you be so sure there will be deal flow in an opportunistic secondaries market? Now, remember that at the time, the infrastructure market was relatively infant. There was no reliable data on secondaries, and there was also an absence of intermediaries specialising in the space. However, Stafford had been at the forefront of secondaries in private equity and also in timberland, and this was key to our success in being an early mover on infrastructure secondaries. The trends that we observed in the early stages of those asset classes showed us that, as a general rule, we could estimate the secondaries market volume to be approximately 10% of primary capital raised just 5 years prior. So in essence, secondaries are a derivative of the primary markets, just with a time lag. It's not entirely surprising. We still get the question about deal flow today, but fortunately, we have infrastructure-specific data to prove the trend and support the forecasts. As you see on the graph here, the red line, which is to be read on the left axis, represents the primary infra fundraising over the last 20 years. Notably, even despite the impacts of COVID-19, there was 100 billion raised by the primaries market last year, and this was almost double the amount raised just 5 years prior to that. Moving to secondaries volume, which is represented in green and to be read on the right axis, we've estimated the volume by replicating the trajectory of the primary market and applying that 10% rule of thumb with a 5-year lag. The green bars are the actual secondaries volume that Stafford has seen since 2014, and this largely follows that green line, with the exception of 2020, where we saw a dip in volumes. Now, at the outset of the pandemic, we were actually preparing for a boost in volumes on the secondaries market with potentially higher discounts. But with the extraordinary recovery of the public markets, this simply didn't transpire. In fact, we saw less activity overall as investors remained in watch mode. However, going into 2021, we are already seeing a bounce back in volumes. And while we will likely see higher volumes this year, it's not a crisis-driven strategy. and we expect the volumes to continue broadly in line with the original trajectory that we show here. And even based on that trajectory, we would see secondaries volume double over the next 5 years. Another observation that we can make from this chart is the exponential growth of primaries dry powder, which is represented by the blue line and the left axis. What this tells us is that the primary capital is being raised at a faster rate than it's actually being deployed. And this dry powder is having a profound influence on returns, with more capital competing for the assets being sold out of fund portfolios. And we can take a look at this now based on the returns when we look at primaries and secondaries. Next slide, please. So here we have a scatter chart, and it shows the evolution of returns for individual infrastructure assets over the last 10 years. If I can draw your attention to the orange marks, which represent the estimated underwritten returns on deals that we've seen in the direct or primaries market. Putting it into perspective is the orange line, which represents the average of those deals. And we see a steady decrease or a tightening of the returns over time. This is effectively a consequence of low interest rate environments and record levels of dry powder that we saw on the previous chart. Now, if we compare this to the secondary returns on underlying assets by focusing on the blue markers and trend line, we see an increase in returns over time. To provide a like-for-like comparison, we've taken examples of the utilities sector, represented by the square markers, and highlighted some specific examples of assets that we have had exposure to through secondaries on our own. What we observe here is effectively a pricing wedge between the estimated primary and secondary returns, which has increased over time and is being driven by a combination of primary market dry powder and also those growing secondary volumes. Now, the arbitrage that we see here often leads to the misconception that secondaries are all about high discounts from distressed sellers in order to extract value. While we do see some of those opportunities from time to time, there's not a consistent flow, and it's more important to focus on other items in your portfolio, not just the discounts, if you want to create an efficiently deployed and balanced portfolio. And as we'll see on the next slide, entry discounts really only account for a portion of the value that we're generating from secondary investing. Next slide, please. Now, if you consider the market dynamics we saw on the previous slides, you don't need to be a vulture to generate value out of secondaries. What you do need, however, is dedicated people, processes, and systems. It's not a game for the hobbyist. As you will see on the left here, we consider 4 pillars of value. Firstly, research and sourcing. This is about doing your homework on the infrastructure universe of funds and assets well in advance and having a targeted approach to sourcing. I'll come back to this point in just a moment, but we'll continue through. Pricing, secondly. Given secondaries are negotiated off NAV, which is typically derived from discounted cash flows, there's effectively an ability to wind back the clock on today's market valuations. The key, however, is to ensure that the manager's assumptions and forecasts are conservative, and you need to protect the downside. For this, we adopt a risk-based approach, which uses 9 common risk factors applicable to infrastructure in order to provide a level playing field for the analysis of the assets. And this has been particularly useful overall, and in fact, more so in the current pandemic, where we've seen a stronger dispersion of pricing in the market, particularly across sectors deemed the winners and losers in the shifting landscape. Portfolio construction. This is really about utilizing secondaries to create well-diversified portfolio and building core assets spread across different sectors, geographies, vintages, and currencies. And finally, we have realization, which is the potential uplift from mark-to-market valuations at the exit of the assets. If I can draw your attention to the chart on the right, you'll see here the orange markers and the trend line that shows the premiums generated by realised assets over time. We've seen average exit premium to the last 12 months NAV of more than 30%, which, I mean, this really underlies the importance of conservative valuations, but we're also seeing that upward trend, which again ties back to the increasing dry powder in the primaries market. Now, in addition to the attractive returns and the diversification benefits, secondaries, if done properly, can also reap benefits of limited blind pool risk, good insight to the historical performance of the assets that you're investing in, swift cash yield, and mitigated J curves. Next slide, please. So where are they coming from? Well, there's effectively three channels: LPs, GPs, and intermediaries. And as I touched on in the previous slide, it's important to have a wide-reaching and targeted approach. On the bottom right, we see a comparison of pricing offered by sellers between 2019 and 2020. Here we can see a dip in pricing expectations through the peak of COVID-19, but this was mostly just to bake in the expected valuation adjustments we were going to have put through those portfolios due to the pandemic. In Q4, we see these prices mostly return to previous levels as the valuation stabilized. In terms of reasons for sale, this is constantly changing, but we do recognize some common themes in seller motivations. For example, on the LP side, there may be a strategic shift to directs, as we discussed earlier on the Australian market. There may be a change in personnel or CIO, which triggers a change in the investment mix or a different target weightings to sectors or different geographies. There may be some legacy holdings or tail end funds, and larger investors may just want to clean these off their books. There's also liquidity reasons, which may be for contingent or recurring cash needs, or even regulatory reasons for liquidity, such as what we saw with Solvency II and Basel III. GPs, on the other hand, they may be seeking an extension of hold periods to maximize the returns from their funds, and this often includes facilitation of liquidity for existing LPs. The restructures that they bring to market could include anything from a single asset extension to continuation funds for the entire portfolio. Now, given the disruption of the pandemic on M&A activity, we'd expect to see more GP-led processes coming to market over the next, say, 2 to 3 years. And this will be an interesting dynamic for the secondaries market. But we typically find that the larger transactions bring more competitive capital, and we tend to find more value or better value in the smaller LP-driven sales. Now that brings me to the end of my presentation today. So I'd like to thank you all for listening in. I hope you find this information helpful, and back to you, Mr. Cho.
Thank you, John, for your presentation. Infrastructure and renewable energy were the asset class Korean institutional investors are considering to invest. Now the secondary investment is another types of the asset class for Korean investors to consider to invest. So the Starford they set up the office in Korea 2018. So they actually doing some good business in Korea. Now I'd like to invite Sam Pierce from 퀸즈랜드 Investment Corporation. Sam has over 30 years of industry experience in energy and utility sector, spanning operations and investment management and corporate development and strategy and transaction execution responsibilities. Prior to joining QIC, Sam worked for APA Group, Scotland and the AGL, and before moving into industry, he was a lawyer at Clayton UTS with transactional antitrust and corporate finance experience. Sam holds a Bachelor of the Science and a Bachelor of the Law from Sydney University, and a Master of the Business Administration from Macquarie's Graduate School of Management, and these are from the INSEAD Advanced Management Program. So over to you, Sam.
Thank you very much, Mr. Cho, for that kind introduction, and it's wonderful to be here presenting to you today. As you mentioned, my name is Sam Pearce. I'm a partner in QIC's Global Infrastructure team. My role focuses on asset management, specifically across our portfolio of assets in the energy and utilities sector. It's my pleasure today to introduce QIC to you, if you haven't heard of us before, and talk a little bit about our infrastructure capabilities, and also talk about some emerging investment themes we see in the infrastructure space, particularly around decarbonisation, green energy, and opportunities we're seeing in the developing hydrogen space. If we could move to the next slide, please. So QIC is a long-term specialist manager in alternatives, offering infrastructure, real estate, private capital, liquid strategies, and multi-asset investment opportunities. We were created in 1991 by the Queensland State Government to serve its long-term investment responsibilities. And 30 years on, we've grown into one of the largest institutional investment managers in Australia, with approximately 85 billion Australian dollars in funds under management, and more than 115 clients, including government, pension plans, sovereign wealth funds, universities, and insurance, spanning Australia, Europe, UK, Asia, Middle East, and the United States as well. We have a track record of asset stewardship as an acquirer, owner, and manager of nationally significant real assets, such as the Port of Melbourne and Brisbane Airport. And we have over 800 employees across 7 offices globally. Next slide, please. Our track record in infrastructure is built on an established global platform and an active management approach. Our global infrastructure team of more than 50 professionals is located across 5 of our offices worldwide, and we manage approximately 14.5 billion Australian dollars across 20 assets globally. These assets are primarily in OECD countries, and it also includes every state in Australia. We apply a sector-centric and thematic-based investment strategy, deconstructing risk across the sector value chains to identify relative value opportunities for investment across the market cycles. Our key sectors are energy and utilities, which is where I work, transport, and the public-private partnerships sector, as well as social infrastructure. This drives a targeted origination approach, enabling us to build robust, diversified portfolios for our clients. As a result of this, we've realised over 7.2 billion Australian dollars for our client base of approximately 25 institutional investors, and have, since inception of our funds, an annualised internal rate of return of about 14%. We can move to the next slide, please. I thought I'd start the discussion around infrastructure opportunities by talking a little bit about the mega trends that underpin our investment pipeline. And we think about this by building up research thematics across key megatrends, which then drive our sector-centric approach and our search for opportunities to invest. Those opportunities to invest include both origination opportunities, as well as around our active asset management focus on improving our existing portfolio of businesses. I'd like to call 2 out across these 5. So if we could move to the next slide, please. The 2 that I want to focus on today, which are, one back, please. The 2 that I'd like to focus on today are decentralization and localization and sustainability. And I've put a circle around the underlying consequences for infrastructure that we'll touch on. And these are most particularly relevant to the hydrogen economy, which I'll talk a little bit about as an upcoming opportunity. Digital convergence, populism, and customer centricity and aging demographics are all key megatrends which go into our mix when we're considering the opportunities for us to invest. If I can move to the next slide, please. If we start with a discussion around decarbonisation and green energy, and in particular, I'd like to focus on the role of hydrogen, which has been touched on already by Manish earlier on. So thank you for the lead in on that. At QIC, we believe hydrogen has a huge role to play in the decarbonisation and green energy story going forward. Hydrogen is a versatile form of energy, and it's able to be stored for long term and transported globally. When produced from low-cost, zero-carbon sources such as renewable energy, wind and solar, most particularly, and by leveraging existing infrastructure, hydrogen can transform those hard-to-decarbonise sectors like heating and power of homes, offices, industry feedstock such as the production of green steel, where hydrogen would be a key ingredient, and transportation, including forklifts, long-haul trucks, buses, and trains. The hydrogen economy itself provides Australia and Korea with some very exciting prospects, with Korea being the world's leading fuel cell technology producer with a wealth of experience developing refueling stations and fuel cell electric vehicles. It's an ideal opportunity to partner with Australia, which is well placed to be a significant hydrogen producer, but it will be in need of global partners to realise the full potential of its hydrogen strategy. Korea, which has that fuel cell expertise and import shortfall in terms of the energy that it needs to be brought in, could well be this partner. If we could move to the next slide, please. Thank you. So hydrogen has, of course, been a topic that's been talked about many times and coming in and out of popularity over many years. What I thought I'd talk about on this slide is really, I try to identify the driving factors which are making the hydrogen economy something that we expect to be a reality in the next 10 years. These include the continuation of announcements by multiple different jurisdictions and governments around the world of significant hydrogen policies, stimulus arrangements, and decarbonisation targets in their various economies. In particular, both the Australian and Korean governments have identified hydrogen as a crucial technology to transition to a lower carbon future. And there are many other countries which have adopted similar policies, including the US under the recently elected Biden administration, and in the European Union under the hydrogen strategy, as well as the new Green Deal that Manish also mentioned earlier on. Secondly, a key driving factor for the introduction of the hydrogen economy is the rapidly declining cost of renewable energy, such as in particular wind and solar. The process of manufacturing hydrogen is driven by electrolysis, which, when fed with renewable energy, can deliver much more affordable outcomes as that price of renewable energy drops. We've now seen the cost of electrolysis drop somewhere around about 60% to be about 60% more affordable over the last 5 or so years, as the costs of electrolysis and the electricity prices have dropped over that time. And a third factor that's particularly relevant are the continued advances that are needed in research and development for production, storage, transport, and distribution. And that is the case across most sectors, but in particular, I'd just like to call out the fact that Hyundai has recently announced that it's secured approvals for the design and build of large capacity cryogenic hydrogen carriers, which will be essential for the development of the international hydrogen market. And finally, a key driving factor for the introduction of the hydrogen economy is around the increasing demand for environmentally friendly energy and feedstock in those hard to decarbonise sectors. It's always about the demand at the end of the day, and that becomes an issue about how quickly the market develops for that demand. As one of the other speakers, I think it was Manish, mentioned, we are seeing ESG as a particular factor for investors, both retail and institutional, looking for places to put their capital to work. And we're seeing them particularly increasingly focused on environmentally friendly investments, as well as corporate accountability in their own approaches to addressing climate change and related themes. The pace of this change is extraordinary. On the right-hand side, I've indicated the size of the dollars that might need to be invested to meet the forecast global demand. And at QIC, we do expect the hydrogen economy to be well established over the next decade, providing opportunities for investors and driving the next significant leap forward in decarbonisation. This scale of investment will require private capital and provides numerous opportunities for investors across renewable energy to meet the demand for the green hydrogen production, hydrogen manufacturing, the hydrogen supply chain itself, as well as the distribution infrastructure, particularly as it relates to transport. Through targeted investment over the coming decade, infrastructure investors will be well prepared for that transition to a hydrogen-powered future. And we at QIC are undertaking that targeted investment. If I can turn to the next slide, please. Thank you. To bring all this to life, I wanted to talk about some of the current examples of hydrogen investments that we're undertaking within QIC's portfolio that align with this investment approach and thesis. Firstly, I'd like to talk about Generate Capital, one of our portfolio investments, which operates primarily in the United States currently. Generate Capital finances, owns, and manages sustainable investments focused on renewable energy generation, energy storage applications, energy efficiency, waste reduction, and clean transport. One of the things that it does is it partners with a company called Plug Power to enable the rollout of zero-emission hydrogen-powered forklifts across such client bases as Amazon, FedEx, and Walmart. Plug Power has developed a fleet of 40,000 hydrogen forklifts, which are currently in operation across that client base. And it is one of the largest users of liquid hydrogen in the United States to provide the fuel and energy for that forklift fleet. Together, Generate Capital and Plug are enabling the phase out of fossil fuel powered forklifts, which reduces the subsequent air pollution and operational carbon intensity. And they're doing it today for an economic return. Another example I'd like to bring to your attention is within our Pacific Energy portfolio business, which is a platform business developing, owning and operating low-cost, reliable, off-grid power solutions to the Australian resources industry and remote townships. It is primarily based in Western Australia. In an Australia-first project, Pacific Energy, by its subsidiary Hybrid Systems, has been awarded a contract recently to build a hydrogen demonstration plant in the remote town of Denham in Western Australia. And that plant will provide baseload green hydrogen power into a microgrid and power up to 100 homes. Output comes from a solar farm when the solar is available, with the excess solar going into the electrolyzer, which then manufactures hydrogen and stores that hydrogen. And that hydrogen can then be put through the fuel cell to provide power when the sun is not shining. The plant will provide the potential to integrate a hydrogen fuel cell into a complete grid solution to show the benefits and provide a baseload green hydrogen power into a microgrid scenario and satisfy the power needs for a remote community. These are just two of the examples of how we are utilizing our existing platform to develop opportunities in a lower risk process by building on our existing capabilities and assets. But in addition to that, we are investigating multiple potential investment opportunities on a standalone basis. We can turn to the next slide, please. Thank you. We are looking at potential future investment opportunities both within our portfolio and externally. We believe energy and transport sector interlinkages will develop over time and will develop across multiple usage points due to hydrogen's significant flexibility and its ability to act as a low carbon energy source, combined with the capability to store and transport it. So for example, within our energy and utilities portfolio, we believe that there will be opportunities to develop infrastructure which will be needed to produce, store and distribute hydrogen. And we are very focused on looking at that set of opportunities in Australia. We're currently looking at how we can leverage and adapt our existing assets within our portfolio to do this. In relation to transport, we certainly see the export market, which will require significant investment to enable the transport of hydrogen offshore to feed other markets such as Korea. This could include port infrastructure augmentation at two of our key assets, the Port of Melbourne and the Port of Brisbane. And like the forklift example I gave from Generate Capital, there are also many potential applications of hydrogen to support asset decarbonisation across the transport sector, particularly in the adoption of hydrogen-powered haulage and logistics solutions. Next slide, please. That's it for the content of my presentation today. Thank you very much for listening, and thank you to Austrade and Kofia for the opportunity to speak with you today. I hope you found it valuable and interesting. I'm certainly happy to answer any questions. And if you'd like to know more, please don't hesitate to reach out. My contact details are on the slide, and you can also follow the link that is on the slide for our latest research red paper on hydrogen. Thanks again for having me.
Thank you so much, Sam. It was very good, presentation, and thank you for touching about the hydrogen, the economy, and the hydrogen, the opportunity in 2030. So it's good. Now we are moving into the Q&A session. If you have any questions on the speakers, please do not hesitate to ask questions now.
I'm just wondering why, if you're aware of state government in Queensland trying to drive demand by, if you like, committing to offtake of hydrogen, because clearly you've got the money to invest in these projects, the technology is there, the demand is uncertain. Your
yes,
state can drive demand. Why not mandate, encourage that?
Sure, and thanks for the question. Firstly, I should be clear about a distinction between QIC and the state. So we are independent and we invest independently, to be clear about that. But secondly, demand in Australia for hydrogen, first and foremost today, exists in large-scale industrial usages. And that will be for manufacture of fertilizer and other products associated with ammonia. And secondly, in industrial processes around steel manufacture. Queensland as a state has a large footprint on the first of those, but not on the second of those. The core driver ultimately is around the economic comparison between hydrogen manufactured from a green electrolysis process versus hydrogen manufactured from natural gas, for example. And Queensland is very rich in natural gas as a resource. So that becomes the tension. The governments, both state and I should not just pick out Queensland for this, but most of the Australian state governments and the federal governments are looking at ways and means to stimulate investment in hydrogen infrastructure, be that by way of subsidising and providing cheap capital to small scale projects to develop a scale. So they are doing things to promote the development of hydrogen, less so on the creation of demand, more so on the trying to reduce the cost of manufacture of hydrogen so that it can compete against other sources.
Thank you.
Got one more question to Sam. So it's interesting to know that the mega trend underpin QIC's investment pipelines. So were there any changes in investment strategies for infrastructure assets after the pandemic? And one more thing is that due to the pandemic, institutional investors experienced hardships in conducting due diligence for foreign real asset and infrastructure investment. So could you tell us how QIC is conducting due diligence on portfolio assets that consist of several assets? And are there some cases in Australia or other countries which tap into remote due diligence that uses drones or third party?
Sure, thank you. Thanks for the question. Firstly, have the mega trends changed as a result of the pandemic? No, I would say there has been an acceleration of some of those, particularly around the need for digitalization and the drive for digital infrastructure, which was also mentioned by Manish earlier on. We are seeing the decentralization drivers around energy primarily being driven by the decarbonisation position and also a need to provide further customer choice. On the second part of your question around the pandemic impacts and on particular classes of infrastructure, one of the benefits that QIC has is that we have a diverse portfolio. I mentioned we've got those three primary streams: energy, utilities, transport, and the public-private partnerships / social infrastructure parts of our portfolio. And certainly some parts of our transport portfolio were impacted during the course of 2020. We spent a lot of time on a bunch of our assets, working on them to seek to manage them as best we could through the process. But one of the things that I mentioned in a seminar that I presented at in September last year was, particularly in relation to energy and utilities, they demonstrated their resilience through the pandemic impact that we saw in the first half up to the end of the third quarter of 2020, particularly around our energy and utilities assets. A bunch of those assets within our portfolio, in fact, substantially increased their position. So, for example, our Pacific Energy business in Western Australia substantially increased the number of megawatts that it was installing and operating because the demand was there, because customers, the resource sector, was driving those. So we have that is what comes from having a portfolio of assets. You have some that are GDP exposed, some that are exposed to other drivers of the economy, and some regulated utilities themselves, which primarily drive a return which is probably best benchmarked against the risk-free rate. And I can't remember the third part of your question, I'm sorry.
The last question was, are there some cases in Australia or other countries which tap into the remote due diligence that use drones or third party? That was the last
Thank you. Yes, so yes, we recently, we've seen 2020 was a very challenging year to undertake transactions and grow a portfolio, and certainly we, amongst many others, focused on maintaining and managing our existing portfolio of assets as best we could. We've never stopped undertaking an origination function, but it's fair to say that 2020 was particularly challenging. Come 2021, we have already executed on our first deal to add an asset to our portfolio, which obviously we undertook due diligence and commenced that process in late 2020. So we recently added signed to add a district heating and cooling business in the United States into our portfolio. And we ran that remotely to a large extent. What we have had to do is rely on local engineers and technical support to ensure that we do undertake that detailed technical analysis that forms part of our investment thesis. So we do maintain and manage that process very carefully. But as part, like the rest of the world, you know, there's plenty of Teams, Zoom, WebEx calls that we've had with our teams across the world at all times of day and night to try and drive those processes forward.
Thank you. So can I ask one more question to Frontier Advisors, Mr. Manish? Yeah. So you were slightly mentioned about the PPP during your presentation. So, and actually it's a question about the impact of the quantitative easing on the market. So amid the increasing liquidity after central banks quantitative easing in many cases due to the pandemic, and many think that secondary investment in government-sponsored PPP project would become less attractive. So what's your take on this? And additionally, I would like to know whether tapering will have an impact on valuation in the infrastructure market.
Thank you, Mr. Chair. They're two very, very good questions, excellent questions, in fact. So when we think about PPPs, if you stand back a little bit and think about the nature of PPPs, what you want to take them because there's got to be an equal sharing of risk, right? So when you are looking at mental structuring of how a project needs to be developed, whether it's a school or a hospital, there's got to be an equal sharing of risk. And a developer will only come into it if they know that the other party, whether that's a state government or a federal government, is going to stand behind the project over the long term. And in making that assessment, a developer is going to look at in this case, what you call the off-taker, his credentials. So where the state or the state government or the actual national government is actually got a very strong credit rating, has got a track record of honouring its prior commitments to PPPs, and that will generally give you a lot of comfort when you're actually subscribing for projects. Now, just to give you an example of that, if you go back to the last few years in the UK, I think if you're a developer, you'd be reasonably worried about whether the UK would stand behind its PFIs, private finance initiatives. And generally, there's been a somewhat skewed sharing of risk in those relationships because too much risk has been passed on to the developers, the constructors, and there's a bit of a flow-on effect. And in fact, I think it was in 2018 or 19, Carillon, maybe I haven't got the right pronunciation there, but very large contractor filed for bankruptcy. A lot of jobs lost, created a lot of angst in the UK, and that's because there was this unequal sharing of risk in some of the projects that the government had shared. And their argument and justification was, well, we're not really getting value for money from these projects. So yeah, if you're an investor or a developer, my suggestion would be to look very carefully at all the parties who are underwriting those projects, the type of risk they're willing to share, and look at the track record for how they've honoured prior PPPs. But there are governments in Europe, like Netherlands and France, who've actually done a wonderful job in sponsoring PPPs because a lot of these projects are local. They're not overly complex or very large. So it might be to build out, for example, in France, we talked to a manager who's actually been assigned a concession to build out a fleet of green buses. So they were electrifying the buses, and that was done on a PPP arrangement with the local municipality from strong credit rating. So there are projects like that. So I think you just need to be very selective when you're looking at those projects. Now, the second part of your question, in terms of are we going to face any risks in terms of this additional capital? Well, I think I'd argue that we're already in a very low interest rate environment. So the comfort an investor can take is this happens to be one of those asset classes that there's a little bit of grey area when it comes to valuation. So typically in your discount rate, a value of what they might do is actually create a little bit of headroom in the discount rate. So you're not actually valuing the asset on spot real interest rate. You are actually creating a risk-free rate and then creating a buffer on top of that, and then adding on your market risk premium, etc. So where the real rate of return on the bond might be zero or negative in Europe, you'll find the assets in those countries are actually valued at a mid to high single-digit discount rate. So fast forward 2-3 years from now, when all this tapering stops, this quantitative stimulus stops, and then we are at the risk of facing a real inflationary environment, you'll get some protection on the discount rate side from there. Plus, additionally, the smart investors would have been investing in assets which have revenues backed by inflation backing or inflation protection. So in that sort of environment, you'll find the tail end of your assumption should start increasing because you are banking higher revenues from the inflation protection. So in that sort of scenario, you should benefit, or you should come out in a normalized situation. I think at risk are those assets which have actually been priced for perfection in today's environment, and then when faced with the prospect of rising inflation, can't really justify increases in forward revenues, and therefore have to take the hit on increasing discount rates. But I think we're still a while away from that.
Mr. Jakonik, are you still with us?
I am, yes.
Yes, thank you. Yeah. So could you elaborate on changes in the trend of liquidity and discount rate in the secondary market after the pandemic, and its implications for Korean audience?
Sure. Good question. So I think for us, we have seen some movement in valuations, certainly higher discount rates in the DCF valuations that are coming through on the assets within our portfolio. As mentioned in the presentation earlier, there was some delay in recognising these valuations, as obviously with most infrastructure, there's effectively a quarterly valuation. There's also audits which occur generally on an annual basis. So there was some delay in getting that information through, but we've certainly seen the DCF rates being increased and some of those values coming down. However, what I would point to is the fact that most of our investments are into core infrastructure assets. So typically these, including PPPs, for example, tend to have lower DCF rates or discount rates to begin with, and are generally more protected from downside risk. Is that helpful?
Yeah, absolutely. Thank you so much.
Once again, thank you for three presenters from the fund managers delivering very valuable presentation for the Korean institutional investors. At the same time, thank you for the Korean audience to listening for Australian investment opportunity and also the Australian fund management capability. I hope this session will be useful for your business. And if you have any additional questions or if you need some of the presentation materials, then please contact me or Mr. Shim. Then we'll circulate the information to you. Thank you.